Hello everyone. So in today's video we're going to talk about the capital market regulator, which is the Securities and Exchange Board of India, or SEBI, and then we'll talk about the key developments which have taken place in the capital market since 1990. So anytime you have an investor who invests in the securities market and buys products such as shares or bonds, he wants a sense of confidence that the market is going to function in a fair and transparent manner. So you have the capital market regulator called the SEBI, which is responsible for discharging this function, and SEBI was set up in 1988. So while SEBI was set up in 1988, it did not have any statutory authority until the enactment of the SEBI Act of 1992, and this was done based on the recommendations of the Narsimham Committee on Financial System, and this committee was set up as part of the liberalization, privatization and globalization reforms of 1991. So you had SEBI, which was set up in 1988, but it was conferred statutory powers in 1992. So prior to SEBI, the capital market was regulated by another entity, and that was called the Controller of Capital Issues. So in addition to this, there was another institutional development, and that happened in 2015, and that was that the Forwards Market Commission, which used to regulate the commodities derivative market, that entity, which is the Forwards Market Commission, was merged with SEBI. So post 2015, you have SEBI, which regulates the commodities derivative market. So having understood the basics of SEBI, let's understand the main functions which the SEBI discharges. So the first function is that it's responsible for the regulation of the securities market. That is, SEBI is responsible for regulating the different stock exchanges which function in the country, such as the National Stock Exchange or the Bombay Stock Exchange. In addition to this, it's responsible for formulating rules for different market participants, such as stock brokers or merchant bankers, and it's also responsible for ensuring that the rules it's formulating is being followed by different market participants, so as to ensure that the trading which takes place in the market is fair, transparent, and is being conducted in an orderly or impartial manner. So that's the first function of SEBI. The second function is that it's responsible for regulating the different market participants. As we talked about, you have different market participants such as stock brokers that help facilitate trading. Then you have merchant bankers which help companies raise funds. In addition to this, for example, you have mutual funds which help investors invest in the capital market. So before any of these entities can actually provide services in the capital market, it's required that they register themselves with SEBI as well as comply with the different rules which SEBI has in regards to different market participants. Now all of this is done so that the investor interests are protected. The third key function which SEBI performs is that it's responsible for preventing unfair practices in the capital market. That is, it's responsible for preventing unfair practices such as insider trading, price manipulation, as well as other fraudulent activities, so that the investor interests are not harmed. So let's say you have a company's executive who's using confidential price information so as to buy or sell shares in the market before such confidential information is available to the general public, so as to make unfair gains. Now in these situations, SEBI can investigate the executive or the company and impose penalties on that company as well as its executives who are engaging in such fraudulent activities. So by this, SEBI can ensure that the market is impartial and it is creating a level playing field for different participants. The fourth function of SEBI is that it's responsible for investor protection and education. That is, you have SEBI which conducts different investor awareness programs, and through this SEBI educates different investors on what the financial market is, what are the different financial market products such as shares, bonds, mutual funds, as well as it also educates investors on different types of financial frauds, online scams. In addition to this, you also have the SEBI, which issues warnings and guidelines to prevent investors from investing in fraudulent schemes. Besides this, SEBI is also responsible for training different market participants such as stockbrokers or merchant bankers or investment advisors so that they act in a professional and ethical manner. Now, the fifth function of SEBI is that it's responsible for regulating the credit rating agencies. So you have different credit rating agencies which function and assign ratings to different borrowers, and these ratings symbolize what is the likelihood that borrower will repay the money it is borrowing. Now this helps an investor make an informed decision in regards to where to invest or who to lend money. So thereby the role of credit rating agencies is important because their ratings can impact how safe it is for an investor to invest. So that's why SEBI regulates these credit rating agencies and monitors their functioning so as to ensure that the ratings which they are providing is credible and impartial so that the investor interests are protected. So this was all in regards to the functions of SEBI. Having understood this, let's talk about the key reforms which have taken place in the capital market since 1990. So the first is that you have something which is you have disclosure based regulation. That is, SEBI does not require or SEBI does not tell investors where to invest. In fact, what it does is that it creates an enabling environment for investors, and it does that by asking companies to disclose different aspects in regards to the company, such as different types of financial information when that company wants to raise funds. So for example, a company is required to disclose information as to what are its profits or loss, as well as what are the different types of risks that company is facing, as well as provide details in regards to the profile of different directors in the company, as well as where it's going to use the funds. So because it creates an environment where investors are aware as to where the funds are going or what is the profile of the company, an investor is able to make informed decisions. So this was a key development which has happened in the capital market post 1990. The second key development is that you have dematerialization of shares which have happened. So earlier what was happening was that shares were being issued in form of physical paper certificates. So every time you had buying and selling of shares, so you had these physical paper certificates which were being transferred, and as a consequence of this process would take a lot of time. There was a risk of damage to shares, there was a risk of theft, forgery, and so on. So in order to prevent that, what you have is that now you have dematerialization. That is, shares are now held electronically in demat account, and in order to do that, you have two key depositories in India, which is the first one is the National Securities Depository Limited, and the second one is the Central Depository Services Limited. So these two depositories maintain electronic record of shares of different investors, and they facilitate the transfer of shares when there is trading between investors. So now you have dematerialized form of shares, that is electronic form of shares, and paper form of shares no longer exist. The third key reform which has happened is that you have a rolling settlement cycle. That is, once a transaction has happened in the securities or the capital market, and in order to complete that transaction, that is moving the funds from the buyer to the seller, as well as say moving the shares from the seller to the buyer, that process is done within 1 day after the transaction. So let's say if you sell shares on Monday, you are on Tuesday going to receive funds for the shares you have sold. So this process helps ensure that there is lesser risk of default, as well as there is more liquidity as well as efficiency in the capital market. The other key development which happened was that you have foreign investors which were allowed to invest in the Indian capital market post 1991 reform. So earlier than that, or prior to that, the foreign investors were restricted when it came to the Indian capital market. But now you have foreign investors or foreign portfolio investors such as foreign mutual funds or pension funds, which have been allowed to invest. Now the benefit this provides is that it provides a new source of capital for Indian companies, as well as it integrates the Indian economy or the Indian capital market to the global capital market. So this is the other key development which has happened. The fifth key reform is that the Indian companies have been provided access to the international capital market. That is, Indian companies post 1990 are allowed to raise funds from abroad via different instruments such as ADRs or American Depository Receipts, GDRs or Global Depository Receipts, as well as external commercial borrowings. Now we're going to talk about each of these instruments in detail in subsequent video, but the key learning out here is that Indian companies, like foreign companies, are allowed to invest in India and help Indian companies raise funds. Similarly, Indian companies are also allowed to tap foreign stock markets and raise funds from abroad. So these were the key developments which have happened in regards to the capital market since 1990. So this is all we wanted to discuss in context of today's video. I hope you liked this video. If you did, follow the channel for more concepts in regards to economics. Thank you so much for watching.